yesterday we learned that Jeff Bezos, one of the richest men in human history, is going to go into space in a few weeks' time, flying aboard the first trip launched by his own rocket company. The man owns a rocket company. But today we're learning that Bezos, currently worth over $188 billion here on Earth, once claimed a $4,000 tax credit for his kids. Bezos claimed that credit in 2011, a year in which he also paid $0 in federal income tax. Zero. His worth back then, a mere $18 billion. Those are some of the revelations in a ProPublica report on how America's wealthiest individuals avoid income tax. ProPublica doesn't say exactly how it got the tax data, only that it was provided in raw form after it published a series of articles scrutinizing the IRS. The Biden administration is now investigating how ProPublica got the records, with a Treasury spokesperson saying the unauthorized disclosure of confidential government information is illegal. But here's what ProPublica's reporters found after months of analyzing that data. Jeff Bezos isn't alone. Liberal donor George Soros, former New York Mayor Michael Bloomberg, billionaire investor Carl Icahn, and yes, Elon Musk too, also paid nothing in federal income tax in certain years over the past couple of decades. To capture just how the ultra-wealthy are able to legally benefit from a skewed tax code, ProPublica ran an analysis comparing the wealth of the ultra-rich to that of the average American and the taxes each group paid. From 2014 to 2018, the 25 richest Americans saw their worth grow by $401 billion. In that time, they paid $13.6 billion in federal taxes, which ProPublica's analysis suggests is a rate of about 3.4%. Middle-class Americans, on the other hand, saw their worth grow by about $65,000, mostly from rising home values. But because the bulk of their earnings are from salaries, not investments or dividends, they paid nearly $62,000 in taxes, almost the entire amount of their wealth growth. Put another way, by the end of 2018, the 25 richest Americans were worth $1.1 trillion. It would take more than 14 million ordinary Americans to equal that same worth. Those 25 ultra-rich Americans paid $1.9 billion in personal federal income taxes in 2018. The wage earners, the bigger group, paid $143 billion. That sounds fair. Now, ProPublica's measure is admittedly one they created themselves. It's not some widely accepted academic or economic measure. They used wealth growth basically as a proxy for income, which critics of the report say is improper. Income is taxed right away. Wealth includes things like stocks, real estate, other investments. Those can't actually be taxed until they're sold. And by the way, that tax rate is generally lower than it is for wages. But that doesn't change the fact that we do have a tax system, especially an income tax system, that allows the absolute richest people in the country, in the world, to pay nearly nothing, or in many cases, nothing, in federal income tax. See Jeff Bezos, see Elon Musk, see Donald Trump. Remember when Hillary Clinton brought up Trump's alleged tax avoidance in a 2016 presidential debate?
Or maybe he doesn't want the American people, all of you watching tonight, to know that he's paid nothing in federal taxes, because the only years that anybody's ever seen were a couple of years when he had to turn them over to state authorities when he was trying to get a casino license, and they showed he didn't pay any federal income tax. So
that makes
if
me
he's
smart.
paid...
Maybe that is smart. And yes, it is legal. But you know what it's not? It's not right. It's not fair. And it's a reminder of how the tax system in this country, like the rest of our economy, is rigged in favor of the super rich at the expense of everyone else. So how do we fix it? President Joe Biden wants to marginally raise income tax rates on households making more than $400,000 a year. His proposal is to increase the top rate of tax to 39.6%, up from the current 37%. For context, historically, the top rate was over 90% after World War II and during most of the 1950s. Biden also wants to raise the corporate tax rate to 28%, though he signaled openness to maybe 25%. In either case, that's lower than the 35% rate before the Trump tax cuts of 2017, and nowhere near the peak of 53% in the late 1960s. But one thing Biden isn't backing that's much harder for the Bezoses and Musks of this world to avoid is a wealth tax. which many progressives within his party are pushing for, but he's saying no. Joining me now are economist Arthur Laffer, founder and chair of Laffer Associates. He was a member of President Ronald Reagan's Economic Policy Advisory Board and also an informal advisor to President Trump, too. Also here is Anand Giridharadas, publisher of the Inc. newsletter and author of Winner Takes All, the elite charade of changing the world. He's also an MSNBC political analyst. Thank you both for joining me tonight. Anand, let me start with you. What is your reaction to this report from ProPublica? What does it confirm for you, and what does it tell us that we didn't already know in terms of the super rich and their tax levels?
In sober, dense, devastating detail, this report makes a case for a wealth tax like few things I have ever seen. Taxing billionaires' income rather than their wealth is like giving medals in a pie-eating contest according to people's shoe size. It is simply measuring the wrong thing. The thing that makes billionaires wealthy is not their annual income, because they can actually just decide what their annual income is, as the report showed. Their wealth is what makes them wealthy, as a simple analysis of that word would reveal. And so unless you are taxing the thing you mean to be taxing, you are handing out pie-eating contest awards based on shoe size.
A nice analogy. I enjoyed that. Art Laffer, welcome to the show for the first time. What is your response to that report from ProPublica, especially to the fact that Jeff Bezos reportedly paid no federal income tax in 2007 or 2011? Elon Musk paid zero in 2018. These are two of the richest men in human history. How is that okay?
You know, Mehdi, this is exactly what I talked with you about at Oxford. I tried to go through the Warren Buffett example, which is exactly what ProPublica has come up with. Warren Buffett, goodness knows, was wonderful in releasing his tax return in 2010. So we got to see all of these numbers, which are exactly the same as what ProPublica has divulged. And Anand, it's good to see you again, by the way, as well. What this is not indicative of is not a wealth tax. What you've got to look at is what was the income, and what ProPublica said was income is exactly correct. Income is what you spend in a year, what you give away, and the increase in your wealth. That is income, and that's what should be taxed. That is what I proposed with Jerry Brown when he ran for president in 1992 in the Democratic primary. We had the 13% flat tax. If any of you remember that, that taxed the increases in unrealized capital gains, which is what we should have always done. Warren Buffett in 2010 had an income of about $12.2 billion. He had an increase in wealth with Berkshire Hathaway stock of $10 billion, and he gave away, one of the things you guys don't even look at, are 501c3s. Warren Buffett gave away about $2 billion in 501c3s to his two sons, his daughter, his wife, and, of course, the Gates Foundation. Okay. These all should be taxed at flat rates across the board and be done with it and get the money. We'd get so much more money. The economy would be so much more efficient. But ProPublica is exactly correct. And they should have taxed the increase in wealth as it does, but not the level of wealth.
We'll come back. We'll try and come back to the flat tax in a moment, which, as you know, many people regard as regressive. But Anand, let me put this point to you. Many on the right have criticized ProPublica's analysis, saying you can't replace income with capital gains, with unrealized revenue, unsold assets. And they say the way that ProPublica calculate this effective tax rate is not the way most economists or official figures do. That's a fair criticism, isn't it?
I don't think it is, because just as homeowners have to pay, wealth tax on their homes, whether or not they have the liquid cash to find out a way to do it, so should wealthy people on their wealth. I don't know if we're hearing breaking news of Reagan tax cut architect Arthur Laffer having a religious conversion to a wealth tax that he's not calling a wealth tax. But Arthur, I think it's, to be honest, time to have an honest talk about your legacy in this issue. I mean, it's fine for you to decry what ProPublica is reporting, but the truth is you are one of the architects of this legacy of misery in this country. You've dedicated your life to the kind of pseudo-intellectual ammunition for the plutocratic hijacking of this country that ProPublica reports. You, through your advocacy of supply-side economics and trickle-down, have a legacy of hurt and pain and stagnation that is unparalleled among economists. That homeless vet that I walk by on the street who is hurt by gutted government programs, he is your handiwork. Arthur Laffer, and you know that. The child in the Bronx whose art classes are no more, that's your son. The waitress who took a chance on a degree and died before paying off the degree, that waitress's pain is the result of you advocating from the 80s onward for the kind of trickle-down, cut taxes from the rich, social justice, downward Ponzi scheme, and it's fraudulent, and I'm glad you're waking up to reality.
I think we have to let Arthur Laffer respond there to a series of points you made against him. Art, over to you.
Hassan, what I wrote this paper in 1981, which is the complete flat tax, which is just what ProPublica announces as the income, and that would be the flat tax that would be done. In the 1986 Tax Act, what we did was we did lower the tax rates down to what is it, 26% or so, and we broadened the tax base. We did include lots of write-offs that should not have been excluded for years and years and years. They did not take my advice at that time, and including as part of income increases in unrealized capital gains. But let me just tell you, Anand, you're totally wrong. All economists, this is the Haig-Simon definition of income that has been used in this ProPublica piece, and they are exactly correct. And that is exactly what should be taxed. And that is exactly what I have said from the beginning of time. I just think you should have a flat tax across all income with no deductions, no exemptions, no exclusions. If that had been done in 2010, Warren Buffett would have paid $1.5 billion in taxes.
Just to be clear, both of you are saying tonight on the show that you would like to see these billionaires pay more in tax. Although, Art, you're saying you could do it with a lower tax, a lower... And my question to you is, you have always said that, and I remember when I interviewed you in 2017, this was after the Trump tax cuts on my Al Jazeera English show at the time, you had said at the time that this would be a huge boost for the economy. You said it would lead to 3 to 4% growth, as Trump had promised. It would lead to greater revenues. That didn't happen. NPR, I think we can pull the quote up on screen. NPR in December 2019, before the pandemic, reported, quote, corporate tax revenues fell 31% in the first year after the cut was passed. Overall tax revenues have declined as a share of the economy in each of the 2 years since the tax took effect. And growth was 2.9% in 2019, Art, which was the same as it was in Barack Obama's last full year in office. So you and I have talked before. We've heard about this, cut taxes, everything will be amazing. That hasn't worked.
Can I respond to you? Number one, after the Trump tax cut, tax revenues did rise. They clearly fell in corporate taxes, but other tax revenues from the federal government rose. The growth in tax revenues from the fourth quarter of 2017 on were higher than they were in the 2 years before and the 2 years before that. If you look at it, poverty levels dropped to the lowest levels ever, especially of minority groups. It is incredible the prosperity that occurred from that. Now, you clearly can never use tax revenues as a share of GDP because that is wrong, because the tax cuts increased GDP and they increased revenues, and the ratio, we don't know which way it goes, but it did increase tax revenues, which is what we said it would, and it did do it. And anyone who says the opposite,
it certainly didn't. It certainly didn't boost GDP to the 3-4% that you said on the show in 2017. We never reached that level of annual growth. Not in annual growth. Okay, let me bring Anand back in. Anand, you talk about a wealth tax. A lot of people, not just conservatives, many liberals, centrists, people in the Biden administration say wealth tax is not on the agenda, wealth tax won't work. European countries that brought in a wealth tax had to get rid of it because it didn't work. What do you say in response to that this is a tax that the Democrats in office don't want and that doesn't work? What do you say in response?
Well, I don't care if it's on their agenda. I care to put it on their agenda through advocacy, which is what you have to do. And, it's laughable to hear Arthur now saying that, GDP went this and that and taxes actually got up and this, if you measure this tax, not that tax. For 40 years, his theory has been tested. His theory was written on a napkin with two other very reputable people, Dick Cheney and Donald Rumsfeld at the table, wrote in a napkin that if you cut taxes, government revenues will go up. Counterintuitive, right? Well, that turned out to be true only if up means down, and every day with this logic is opposite day. So now we have the ballooning deficits. Now we have the ceiling high debt. 40 economists polled about these ideas in 2012 said unanimously they carry no water. So we need to try a different way and to put on the agenda of the Biden administration the notion that if we don't not simply get people to pay their fair share, that's not what we're talking about. That's the Elizabeth Warren language, Bernie language even. We actually need to talk honestly about cutting these fortunes down, making them smaller. Even the Bernie and Elizabeth wealth tax plans would not do that. They would just clip the growth. We need to actually shrink.
Anand, we're running out of time, so I'm going to jump in.
Yeah.
You made the point. Art, very briefly, do you agree with shrinking down these fortunes? That these people just have too much money in a democracy?
I think we should not have a wealth tax. I think we should go back and have a flat tax on total income, the Hague-Simon, and I would be glad to argue and have a debate with Anand if he ever looked at facts. He went to the same prep school I did, a very great privilege there in Cleveland, Ohio, and I don't know why he's arguing against his own class in Cleveland, but that's fine. The way you run an economy is to create prosperity. These people should have paid a lot more in taxes with a broad-based flat tax. That's what they should have done. I've always argued that.
Okay, you've made that point before. Okay.
And, you know, and all I wanted to say...
Got it. I'm just trying to save time because you both made these points. Hi, I'm Mehdi Hasan. Thanks for checking out our channel on YouTube. You can see more of the Mehdi Hasan Show by clicking on any of the videos on this screen, and make sure you subscribe below to stay up to date on the day's biggest stories. Thank you for watching.